In the standard form of CAPM model, we have looked at the formula earlier, saying the return on the expected return on a security is same as risk-free rate of return plus beta times RM minus RF. When this particular formula was introduced, or when we are using this formula, there are so many assumptions that have gone into the derivation of that particular formula, wherein we are considering that there are no transaction costs, mostly to do with the brokerages, and those kind of costs are not there. Only in when all these assumptions are fine, then only we are talking about the very much applicability of the CAPM kind of a relationship. So there are no transaction costs. And one more thing that it is assuming is the assets are infinitely divisible, which means I can even buy zero point 0.1 share, I can sell 0.02 shares, which in reality is not possible. Only integer number of shares, or in some cases a minimum lot has to be bought or sold. So that is one more assumption that has gone into the derivation of that CAPM formula. There are no taxes, which is a very ideal or probably expected kind of a situation, or probably desirable kind of a situation, but maybe far away from reality. And one more major assumption that it makes is all investors are price takers only. Means no one is going to influence the price. Everyone is going to take up, which means even if a person has bought or sold in very large quantities also, he is not going to decide the price. He is majorly a price taker itself. That is again a kind of a away from reality, because we have seen that some people, by buying in very large bulk or selling in large bulk, they can very well influence the price in their direction. And it is also said that most of the investors are rational, so they always look at the expected returns and the variances. So they do all these calculations of returns and risks, and based on that only they do the investment, which means it is assuming that all investors are knowledgeable, rational, which is again a kind of away from reality scenario. It is also making an assumption with respect to unlimited short selling is possible. People can, the moment if they are finding out that there is a mispricing, they can sell, they can short sell in unlimited quantities. But in reality, there are restrictions on many instruments with respect to short selling. So even that is a kind of a violation. And it's also saying, it's also made an assumption that the unlimited lending and borrowing can happen at the risk-free rate itself. Probably if I have more money, I can lend it at the risk-free rate, but I can definitely not borrow at the risk-free rate, because the more and more I am borrowing, probably the interest rates will keep increasing with the amount I am borrowing. Probably borrowed for if I have borrowed for let's say 20 lakhs, if 8% is the interest rate, if I borrow for 1 crore, probably 9% will be the interest rate, and if I borrow for 100 crores, probably 10 or 11% would be my interest rate. So typically it's not the same risk-free rate at which I can borrow all the time. And it also made an assumption that investors' expectations are homogeneous across time. Means the investors' requirements or expected returns, they don't change with time, right? Probably if the investor, if he is expecting a 10% return this year, it is assuming that every year he will expect the same 10% kind of a return. Homogeneous expectations with the time. And it is also making an assumption that all markets, all assets are marketable. Sometimes if I am talking about taking the shares in a private company, probably they have a limitation in terms of selling them. They are not marketable. Probably if I have to buy shares, someone has to buy shares in my company, right? I may not be able to market my shares as effectively as a public listed a company which is pretty large, a public limited company. More liquidity happens on the shares of a public limited company versus a private listed or a private limited company. So all these things have to be considered or probably have to be really looked at. If any of these things are not satisfied by any company, probably the risk-free rate of return or probably the RI which we have computed using the CAPM formula will not be a good reflection of the reality. So from that standpoint, we may have to adjust this RI either by plus or minus some kind of stuff. So that is where this chapter focuses primarily on what if these assumptions are relaxed. What would be the impact in case these assumptions are relaxed? Is what at least one or more of these assumptions, okay, if there are transaction costs, what would be the impact? Or if there are taxes, what would be the kind of impact? That's the kind of analysis this chapter has brought out. So before we get into those kind of stuff, initially it is bringing out the point that whatever the CAPM model we are talking of, it is very much a good model at a macro level, which means at a security level, what is the expected return, right? Probably not at an individual investor level. Probably this particular security is having a beta of zero point 0.8. So the expected return on this security should be 15%. But it will not look at, it is not a good number to be used when I am looking at it at a micro level, which means at an individual investor level. Because in reality, what we will see is many individual investors or institutions, they will not hold the same as market portfolio. Sometimes I may hold a more risky than market portfolio. You may hold less risky than the market portfolio. We have already seen in our in one of our earlier chapters, probably when we are talking about uh, this particular point, anywhere this is the market portfolio, this is the optimal. So typically the people below it, they are more and more, they are less risk taking kind of people, so they are more involved in the lending process. Whereas this side, they are more risk taking kind of people, because if they have to generate this kind of a return, they have to hold a more risky portfolio than the market portfolio. So they typically get involved into the borrowing process. So which means not all individuals are holding the market portfolio itself. So some people are holding more than risky, more risky than the market portfolio, whereas someone else is holding less risky than the market portfolio. Which means if the assessment has to be at an individual investor layer, probably CAPM is not a good choice. That is where we are trying to consider if all these assumptions are relaxed to some extent, because CAPM has made an assumption that unlimited short sales can be done, or probably it is saying that risk free borrowing and lending can happen at a risk free rate itself. What if these assumptions are violated? Which means if there are taxes, what could be the impact on the CAPM equation? If there are some non-marketable, because it has made an assumption that all assets are marketable. What if some of the assets are non-marketable? What would be the impact on the CAPM equation? What if each individual investor has a separate expectation? And what if there are a few investors who are affecting the price? Not all investors are price takers. So we are trying to see what if what is the kind of an impact that will be there on the CAPM equation, especially if some of these assumptions are typically relaxed. So from that standpoint, see, when I am saying short sales are disallowed, what is the short sales mechanism saying? Unlimited selling can happen unlimited short selling can happen. That is the assumption CAPM has made. But make sure if you say no, in reality, unlimited short selling is not happening, there are restrictions. In reality, if we see, if a particular security is in equilibrium, right? Basically, like it's not overvalued or it's not undervalued. If a particular security is undervalued, there will be a lot of buying for it. If there is an overvaluation, there will be a lot of selling for it. So, as per the CAPM, it has assumed that unlimited short selling can happen. But we have to understand on the other side also, if the short selling is happening, obviously more and more selling happening, the price will come down. Price will come down means the return is actually going up. The purchase price is actually coming down, which means the expected return is going up, which means as per see typically as per your CAPM equation, this is your overvalued security or this is your overvalued security, anything which is above the security market line, it is your overvalued security, and CAPM has assumed that these kind of securities you do a unlimited short selling. But the moment you